Turn to a big story that we are tracking here this morning. That's the rally that we're seeing in meme stocks. You have GameStop. Shares are surging after a Reddit account linked to the meme trade influencer Keith Gill posted a screenshot showing a massive stake in the company. We could not verify the post here, but GameStop sparking a surge in other meme stock names. You can see that excitement on the screen right now, though GameStop well off the highs that we saw pre-market here. So pairing some of those earlier gains even after the opening trade. It was halted earlier due to volatility. So what does this tell us about what the action we could see in the broader markets? We want to bring in James Gellert. He's RapidRatings International CEO and Executive Chair. James, it's good to see you here. So let's talk about this excitement that we're seeing back once again within the markets, all being driven by this post that we think is from Keith Gill over at Reddit, the account linked to Keith Gill in the past. What does this tell you just about the current investor sentiment right now and whether or not this type of behavior is here to stay when you get someone like Keith Gill posting about that opportunity that he at least sees in GameStop?
Well, I think it indicates we're in a frothier market again. When we have a frothy market, when we have a lot of exuberance, there are momentum players, particularly from the retail side, that are prepared to come in and throw money. In some cases, it's new money that they're investing. In some cases, it's gains from other places that they have made bets over the last year to a few years. But you don't see this kind of a reaction unless there is real excitement and exuberance going on. Otherwise, you just can't see the jumps in stock price in a company like this that still has a lot of fundamental issues to solve, unless there's just a ton of eagerness in a group of investors to be involved kind of at any price.
Well, given that, I want to get your take on what we're seeing today versus what we saw in 2020. We spoke with Wedbush analyst Michael Pachter about what Roaring Kitty's 2020 move on GME meant and why it sort of made sense at the time. Take a listen to what he had to say.
More than 100% of the shares short, and he made that observation. It was astute. He rallied retail investors, Redditors, Reddit raiders to buy into the stock.
So he's talking about that 2020 move sort of making sense given what he was seeing in the shares, this astute observation here. Given what you just heard, compared with what we're seeing today, are investors more likely to lose this time around?
Well, I think a lot of investors have lost pretty consistently along the way. And when you take a company like GameStop that has capitalized, you can argue well and appropriately or inappropriately, but a company that capitalizes on this kind of momentum by issuing new stock is fundamentally diluting the holdings of everyone who has invested to date. So when GameStop issued at the market equity just a few weeks ago, they were effectively diluting the value of each share that each holder had prior. So irrespective of what the share price was, there were more shares, and therefore everyone held a little bit less. So you've got this phenomenon going on as well. In almost each one of the rallies that we've seen, they are coming off. We're not holding the highs. Even today, we haven't held the highs on GameStop. No one wins without someone else losing in a case like this. So there are definitely people with axes for momentum, and they are pushing the stock, and a lot of people are jumping in, but not everyone is getting out at a time when they can make a profit.
James, and I know you've dug into just the fundamentals of this. Has anything changed in that part of the story when it comes to GameStop?
Well, so the financial health rating at RapidRatings is entirely empirical. We look just at the financial statements of companies and analyze the companies against millions of company years that have come prior across industries. And with GameStop, we see them now rated at a 50 on a 100-point scale. So it is right in the middle of our medium risk territory. That's the short-term risk, the financial health rating. The core health score is currently rated at 26. The core health score looks out multiple years at how fundamentally strong or weak a company is. So what you've seen with GameStop over the last few years is a minor uptick in the financial health rating, but actually a decline in the core health score. And for any company that looks like this, what that's essentially saying is that the fundamentals of the business are not improving or slightly deteriorating, but the liquidity of the business is propping it up in the short term. And that's what you see mirrored in the fact that they are able to periodically raise more equity and therefore cash. They don't have a lot of debt. That speaks well for them. They have been paring their losses. That speaks well for them. They still haven't been profitable in about 5 years. That doesn't speak well for them. So the real question here from a fundamentals perspective is, does GameStop have a plan? And is the plan one that they can sell to a more sophisticated, consistent institutional audience, not the momentum retail players? Because that plan needs to show that the company is on track to be better at some point in the future when liquidity isn't quite as easy to get and when that fuse life actually burns out.
Taking a step back, James, I wonder, if you look at the Yahoo Finance trending tickers platform right now, you can see that BlackBerry is trending far above even a name like NVIDIA. And it makes me wonder if there is an opportunity here for investors to sort of get an edge with some of the memeier names in the space when you've got a big tech powerhouse like NVIDIA that one could argue is already getting a lot of attention and has higher valuations. Is there an opportunity for a potential edge on these meme names?
Well, there's an opportunity, but you have to question what the opportunity risk ratio is. And there's no question that people can make money in these stocks because they're moving so much in a short period of time. The question really is, are they prepared to take the risks of losing a significant amount of principal in the case that the volatility turns against them? And that's what we've seen time after time. But there's definitely upward movement in each one of these, but people have to be prepared to be in and be out. And certainly no one, Gil or anyone else, is touting a position and saying, I'm holding this position for 5 years or some longer term period that would suggest a buy and hold strategy. Everything that is around the meme stocks is about getting in and getting out or squeezing shorts or doing something that is a shorter term activity. Even the options position that I believe he posted or is attributed to him posted in the last 24 hours is a relatively short term contract. So it needs to have momentum in order to be in the money and to be sold, which is undoubtedly a real reason why someone would want to inject more momentum in. If you want to ride along for the gains that you may get in that process, I think that's a totally reasonable thing to do, as long as it's done with a conscious understanding that the potential to lose money is significant.
All right, James Gellert, RapidRatings International CEO and Executive Chair. Thanks so much for jumping on with us here this morning.